Hi, this is David Humphries again with another of my tutorials on how you can become financially free in property, and this is a tutorial on tip number 2, which is always buy with a loan or a mortgage. This financially free tip compares the results of buying with cash only or combining your cash with a loan or mortgage, which means leveraging your cash, and compares 3 different loan to value percentages. Okay, before going on to look at the variables, just to remind you that this is an unscripted tutorial and delivered as I would a lecture. Alright, let's look at the variables that we're going to play with in this tutorial. Cash sum to start with, £25,000. The opening LTV is 70%, and the LTV variation I've set at 5%. I've set the gain rate at 6% and the gross yield at 10%. The gross yield is the rent as a percentage of the value of the property. Interest rate in this tutorial is set at 5%, and the operating costs are 17%. Now I've combined within the operating costs the letting and management fees, which would be typically 12%, 10% plus VAT, plus property insurance, 1.25%, 1.5% of value, plus repairs and maintenance and statutory checks. So altogether, totaling up to, let's say, 17%. And this is 17% of the rent. In later tutorials, I will be splitting these operating costs between the letting and management charge, the house insurance or property insurance, and repairs and maintenance. Okay, so let's look at the results, and let's open with this cash position. And some investors do buy for cash. I know a number who are debt averse and who do not borrow, even though, as I will show you in this tutorial, there is substantial advantages in borrowing, provided you can get the numbers right. So the cash position, loan to value obviously is 0%. Property value is £25,000 because that's the cash sum we're starting with, and it is possible to buy properties at that price today, £25,000, though whether they're in a lettable state is debatable. Now, looking at first of all at the gain side, assuming a gain rate of 6% a year, at the end of the first year the property will have increased in value from £25,000 to £26,500. Now this represents a return on cash, and this is the important return which will come through all the tutorials or the financial tutorials in this series, is the return on cash. You've invested £25,000, you're getting a £1,500 increase in the value of the property, so it's a cash gain of £1,500, which represents a 6% return on the cash invested. So, and to move on to the rent of 10% on a £25,000 property is £2,500. The operating costs at 17% of the rent is £425, and obviously there is no interest to pay because there isn't a mortgage. The resulting cash in your bank is just over £2,000 or £2,075, which represents an 8.3% return on your cash, return on this £25,000. Now, in the present economic climate, this is early 2012, January 2012, these two returns might be considered quite reasonable on a cash basis. But with buy-to-let, with property investment, you can borrow, and you can borrow a substantial part of the investment. So let's look at the 70% route, and 70% loans or 70% mortgages are readily available. And this is where you're borrowing 70% of the cost of the property. So taking up a 70% loan with your £25,000, you're able to buy a property costing £83,000 or just over. With a gain rate of 6%, this property at the end of the first year would be worth just over £88,000. A £5,000 cash gain. Cash gain £5,000 as against the £1,500 gain made with the cash purchase. And the reason for this dramatic difference is that you've leveraged your money, and instead of buying a £25,000 property, which has increased in value by 6% to £26,500, you've bought a property worth £83,000, which, using the same 6%, has increased by £5,000 to £88,000. And this represents a 20% return on your cash, as against a 6% return where you didn't take up any loans. Moving on to the rental situation, a 10% rent, the same rent that we applied under the cash route, returns £8,333 a year, 10% of the property value of £83,333. Operating costs have increased, obviously, because they're based on the rent in this tutorial, to £1,417 from £425, and you also have to introduce interest at 5% on the loan. Now, the loan isn't £83,000, it's about £58,000, which is 70% of £83,000. So you're paying 5% on £58,000, which totals £2,917. As a result, if you take the 8,333, deduct £1,417, take off £2,917, you're left with £4,000 cash in your bank. And this is close to double the cash result, and represents a return on your cash of 16%. £4,000 is 16% of £25,000. So immediately you can see that by borrowing, you are increasing the returns on your cash invested considerably. Now let's look at what happens if you borrow 75% of the cost of the property. And today, 2012, 75% loans are easy to take up. Above 75%, it gets a bit more difficult, but lenders are quite happy lending 75% of the cost of the property. With a 75% loan, you can buy £100,000 of the property. At the end of the first year, with a gain rate of 6%, same 6%, the property would have increased in value to £106,000, a gain of £6,000. Now, obviously, you can't realise this gain, you can't cash this gain in unless you sell the property. And we'll come to the advantage of the fact you can't cash it in, because this gain would in fact compound itself year on year. But taking a 1 year end position, your cash investment of £25,000 has now increased in capital value to £31,000, and this £6,000 cash gain represents a 24% increase or return on your cash, as against 20% at 70% loan to value. Continuing on down with the rental situation, 10% rent returns £10,000 a year, because £10,000 is 10% of £100,000. Operating costs have increased because the majority of these operating costs are based on letting and management, which is a percentage of the rent. So the operating costs have gone up to £1,700 from £1,417, and the interest charge has also increased because you've borrowed more money. You've borrowed £75,000 in this example, as against £58,000 at the 70% loan to value example. The result is, if you take the £10,000 and deduct £1,700 and then £3,750, you are putting into your bank, cash in the bank, £4,500 or £4,550 over the year. And remember, this is monthly cash flow, assuming that your rent is paid monthly. The return on cash has increased from 16% to 18.2%. £4,550 is 18.2% of £25,000. We haven't changed this cash sum invested, even though the returns are rising. Let's look at the 80%. Let's jack it up to 80% loan to value. And here you're able to buy £125,000 of the property, borrowing £100,000. At the end of the first year, applying the same 6% gain rate, the property would have increased in value to £132,500, which represents a 30% return on your cash, the percentage return on your cash, and is effectively a cash gain of £7,500. £1,500 up on the 75% loan to value, which itself was £1,000 up on the 70%. And as you can see, as you step up the loans to value by 5% in these cases, these examples, the cash gain increases by a larger amount with each step. Now, moving on to the rental, 10% of £125,000 is £12,500. Operating costs rise again because they are a percentage of the rent, and they rise to £2,125 in this example, and interest again rises. Remember, we're borrowing £100,000 at 80% loan to value, 80%. So the interest rises to £5,000. But deducting from the £12,500 rent, the operating costs and the interest charges leaves you with £5,375 in the bank at the end of the year. And remember, this is paid monthly, as against £4,550 at 75%. This represents, by the way, a 21.5% return on your cash of £25,000. So, this obviously indicates that it's better to borrow. Hence I say, always buy with a loan or mortgage. In the case of capital gain or increasing value of properties, because you've increased the asset value in each case by borrowing, and the gain is based on the asset value, the gain increases. And because the rent is generally speaking based on the asset value as well, the rent increases as you increase the asset value. And provided you can contain the costs and get sufficient margin between the interest you're paying and the gross yield, then you will create a good profit on the bottom line, cash in your bank monthly. Now, I pointed out that the cash gain went from 5,000 to 6, a £1,000 jump on a 5% increase on the loan to value. Then we increased by another 5% and it jumped by £1,500. The same applies to the cash in your bank on the rental side. £4,000 at 70% jumped by £550 at 75%, and then jumps up higher to £5,375, a jump of £825. Now, I want to show you what happens if we increase this loan to value, this column here, to 85%, which was the common LTV that applied or was available prior to the credit crunch. It's still available today. There are a few lenders lending 85%, and I think this 85% LTV will creep back in again. So I'm going to change this to 75%. And this column here will become 75, then 80, then 85. And remember, the 80 is 5375. And here's the result of 85% loan to value. Property value has increased from 125,000 to 166,667, close on £170,000 of the property. The gain rate at the same 6% increases the value of this property at the end of the first year to £176,000, or just over, a £10,000 cash gain. So we've jumped by £1,500 from £6,000 to £7,500. Increase it by another 5%, it jumps by £2,500 in this example. And this represents a 40% return on your cash you started with. Looking at the rental figures, 10% rent is 16,667. Knock off the operating costs and the increased interest, obviously, and you end up with £6,750 in your bank through the year, a 27% return on your cash. And once again, the increase is greater. 825 was the difference between 80 and 75%, but push up the loan to value by a further 5%, and the increase is £1,375. So this demonstrates that in the case of both cash gain or going for capital gain, or going for yield, provided you can get these numbers correct, it always buy with a loan or a mortgage. Because at the end of the day, it will put more cash in your bank each month, and it will make you wealthier. Okay, that brings me to the end of this tutorial. I thank you for watching and listening, and this is David Humphreys, looking forward to seeing you on tutorial number 3, but in the meantime saying have a good day and goodbye.